The real estate market 25 is officially stuck, right? Inventory is extremely high, interest rates were higher, sellers can't sell, buyers can't buy, and agents, wholesalers, investors are starting to struggle. And you need to pivot. I'm going to tell you this one thing, that the solution isn't what everybody's saying. The price has got to be lower, the rates got to drop, or I'm going to wait for rates. But the thing you got to change is your strategy. And today I'm going to show you exactly how to do that using one powerful strategy that's going to be vital to closing deals in today's market. But before we get to that strategy, we got to see what's happening across the market, right? What kind of investor, agent, or person in real estate are you if you don't know what's going on? Well, as of April of this year, active home listings hit 959,251 listings. That's up 30% from last year. We're clearly in a buyer's market, but there's a problem, right? Because buyers aren't buying. And in the past, when it was a buyer's market, houses were still selling, and they were even selling over list price, right? They would get way better pricing before. But the problem we have now is a side effect from then, right? Back during COVID, sellers wanted top dollar and buyers were paying 80 grand over list, right? But today's market, buyers can't afford top dollar or top interest rates, right? Today's average 30-year fixed mortgage rate is 6.97%. And that's keeping a lot of conventional buyers on the sideline. And a lot of the buyers are either waiting or being completely wiped out from interest rates. And now we have another crisis. On top of that, everybody else before, because the economy is kind of rough, people, maybe they're not making enough money, things cost more money, whatever it is, but foreclosures are on the rise. In April alone, 25,265 properties entered foreclosure. And that's a 16.1% year over year. And that means more distressed sellers and more creative opportunities if you know how to spot it. So we got the high rising inventory, the hesitant buyers, and rising foreclosures. That's a perfect storm or a perfect setup. But what's going on in the nation on average is that. But let's talk particularly about my market in Florida, because that's my home base, right? It's where I live, it's where I do business at. And this is what I'm seeing that's actually playing out here in real time, right? Inventory here is sky high. In April, again, in Florida, it surged 35% over year. Areas like Tampa, North Port, Cape Coral, they doubled their average homes compared to 2022. And right now in Jacksonville, which is my main market, we just crossed over 12,000 active listings. That's the highest I've ever seen in my entire career. Back in 2022, we were at like 6,000 listings, right? And I'm hearing people right now in today's market, the investors today are dropping their prices by almost $30,000 just to get rid of their flips. That's not even working for everybody. So we have homes that are sitting longer, right? The numbers tell us the stories. And as of June 2025, which it's only the 4th today as I'm recording this, right? The median days on market in Florida is 69 days. That's up from 65 days last month. I'm sorry, in March, actually. So from March to now, we're at 69 days average days on market, which is high, right? In Jacksonville specifically, we're on average 57 days in May of 2025. And I'm pretty sure now as recording this, I think we're pushing 70 days on market as the average, right? And last year, it was 47 days on market. That's a 19.9 year over year increase. And these figures show us clearly that the Florida housing market, and from what I'm hearing is most of the Sun Belt states are really starting to cool off a little bit. But homes are taking longer to sell. Buyer demand is dropping. With the home prices still sitting above $400,000 on average, and the interest rates near 7%, many buyers are simply out of the game. And this creates a standstill between desperate sellers and cautious buyers. And as of 2025, America has experienced a dramatic shift toward becoming a renter's nation, right? I heard Grant Cardone talk about this in the past, a couple of years ago. He said, we're going to be pushing towards renter nation, and nobody listened. But now I'm seeing it in real time, right? And that's being fueled by hedge funds and institutional investors that are aggressively buying up single family homes, right? Remember back, before COVID and actually during COVID, everybody that was wholesaling was just, get a deal, lock it up at whatever price, and then just go sell it to a hedge fund and just make money. And then what happened after COVID was hedge funds stopped buying. Those wholesalers didn't know what to do with themselves. They didn't know the market. They didn't know how to run numbers. They all fizzled out. And now here we are again, where they're still buying again, right? In the first quarter of 2024, they purchased 19% of all of the homes in America. 19%, that's huge. And among those lower price homes, their share rose to 26.1%. Here in Jacksonville, they now own approximately 21% of the single-family rental inventory. That's crazy, and that is pushing out so many traditional home buyers. And analysis project that by 2030, institutions could own up to 40% of single-family rental homes nationwide. That's a problem, and that trend contributes to these rising home prices and increased competition, and often from all the cash, corporate offers, surging rent prices, and it's making home ownership less attainable for average families. The U.S. home ownership rate has dropped to 65.1%. It's the lowest over 5 years. So what's happening is that rent versus buy reality, right? The market's dysfunction is pushing more people toward renting instead of buying. And on average, renting is currently about 38% cheaper per month than buying a home in Florida. And in Jacksonville specifically, the cost of homeownership has surged due to increased mortgage rates and home prices. And over the 3-year period, renters may save approximately $27,000 compared to owning a home. Even high-income residents, like in Tampa, are choosing to rent due to their home prices climbing over 67.4% just since 2019. Now, with the foreclosures that we see popping up, Florida was ranked number 1 in foreclosures last year, and the trend is still climbing. And this means more motivated sellers who need creative solutions, or they're just going to go in the hole with a foreclosure on the record, which I don't want that for anybody, and they probably don't want that for themselves, right? Before we talk about using creative finance, we need to understand what this foundation is and how we can help these people get out of this foreclosure, and also help the investors, maybe ourselves or somebody else, actually be able to profit on a deal. But in order to be able to do this, we have to understand the foundation. Hey, what's going on? I hope you're enjoying this video. I want to invite you to a challenge called the Master Market Challenge. Like we said earlier in this video, there's a lot of uncertainties going around, but I'm going to show you how to be able to master and dominate any market in America, to be able to go in there, analyze it, know what to do different strategies, and have the great communication skills you need in order to succeed in this business. If that's something you're interested in, go to mastermarketchallenge.com and go ahead and check it out, read the reviews, see what it is on there. Grab a ticket, grab the VIP experience. What you're going to get with that is not only going to get the training, you're also going to get a portal that's going to have a ton of different information for you to have, a bunch of free training videos, free resources for you. And we're also going to do an hour of coaching every day, Monday through Friday. If you can't come live with me, that's fine. Go ahead, like I said, get a ticket. Every day is recorded. So you have a whole week in advance from the day it was posted in order to go back and rewatch it. Check out the reviews, check out testimonials. If it's for you, I'd love to see you there. Can't wait to train you, help you, and let you dominate in your market. Other than that, get back to the video. And the foundation we're going to be talking about here is just subject to. And you might be saying, what is subject to, right? Maybe you know, maybe you don't know, maybe you've never heard of it, right? But a subject to is when an investor takes ownership of property and leaves the existing mortgage in place, right? You don't assume the loan officially through the bank. You simply take title on the property, subject to the existing financing, meaning that the seller's mortgage stays active, but now you're the one making the payments. And a few key elements of it, right, is that the loan stays in the seller's name, like I said, but you don't need to apply, you don't need to qualify, you're not assuming it, you just agree to pay on their behalf. You get the deed, right? The deed transfers to you or your business, giving you control of the property, but you need to make those mortgage payments. And often you're going to make those through a third-party servicing company to ensure the trust and documentation. After I believe it's 12 months of consecutive monthly payments through a servicing company, that seller could go to the mortgage company that they're applying for a new loan and say, look, my property is being paid off by somebody else, and that wipes their DTI, which is your debt to income ratio, completely out. So there they can go qualify for a new house. Maybe their credit got better over that 12 months, making the payments and that kind of stuff, right? You might be asking, okay, but it's subject to for everybody. When does it make sense? It only really makes sense when the seller needs relief from a mortgage due to maybe a divorce, job transfer, foreclosure, or other distressed situation. And with foreclosures rising 16.1% year over year, in Florida ranking number 1 in foreclosures, we're seeing motivated sellers who need these creative solutions, right? Their mortgage might have a low interest rate between 2.5% to 4%, which is way better than right now nearing 7%, right? They don't need all their equity up front, or maybe they have little equity. So they're okay with somebody else making those payments as long as they're protected. And common objections and questions is, well, why would I want to do that? My name's still in the loan. Yes, it's still in the loan, but we're using a loan servicing company to protect your credit and send proof monthly, right? And you're like, well, what if you just stop paying and then I go back into foreclosure? We use written agreements and servicing Plus, I can't afford a default. Most investors can't afford a default. We use the deed in lieu to protect you, right? It's a piece of paper we put in place. So if I default, the deed transfers back to you automatically. I only win if I keep my promises. And subject to is the key that unlocks that low interest rate financing, right? Because we don't need to go to the bank and get that 7%. We don't need to do credit checks. We don't need to apply for new loans. And once you understand it, you realize how powerful the strategy is, especially in a high interest rate market like we're in today. Now you're like, okay, but here's the next objection, right? Due on sale clause. Listen, if you've been around anybody talking about creative finance for more than 5 minutes, you heard somebody say, but the bank will call the loan due. Yes, can they? They absolutely can, right? But what is the due on sale clause? It's a standard part of most mortgage contracts that says if the property is sold or transferred without lender's consent, the lender has the right to call the entire loan due immediately. In other words, if the deed changes hands and the loan stays in the seller's name, the bank can demand a full payoff. But here's the truth. They can, but they rarely do. Banks don't want houses. They want payments. They want to make money on the interest. So as long as the mortgage is current and being paid on time, they usually leave it alone. But if you want to minimize the risk and you're worried about that, a way to do it legally and ethically, and the most common way to protect everybody, the seller, you, and have the bank not know or trigger the clause, is by simply putting it in a land trust. Like, okay, well, what is a land trust? A land trust is a private legal agreement where the property is titled in the name of the trust. So in this case, where I have a property right now I'm selling to another investor, and he's putting in a land trust. So it's going to be, I can put the address out there, but let's say 125 Duval Street Land Trust, right? And that'd be the name of the trust. And then the beneficiary initially would be the seller. And you, the investor, maybe you're going to assign it, maybe you're going to keep it, whatever you do. But if you assign it, all you do, it just like the seller does after closing, is they assign the successor beneficiary to you. And if you assign somebody else, you can do the same thing. But I recommend you keep it. And it allows the property to transfer, right, without public records showing your name. And it keeps the mortgage and insurance undisturbed, which makes banks far less likely to notice or call on that due on sale. And why this helps is because the transfer into the trust doesn't violate the due on sale clause. It's still in the seller's name technically, and you gain control of the property as a new beneficiary. And the mortgage continues getting paid by you, often through that servicing company, so everything's transparent and safe for the seller. And the key to this is we're not trying to hide anything. We're using a trust to protect the transaction, the seller, and avoid triggering unnecessary problems while delivering a win-win solution for everybody. And now that you understand the subject to and the land trust, and how to turn that into monthly income, with another creative solution that we can stack on top of subject to is how we're actually going to be able to help people on both sides, between the sellers and the buyers. And this is perfect because it's the only way to move when the market is stuck the way it is. And the key to this is called a wraparound mortgage. You might be wondering, what is a wraparound mortgage? Or in short, it's called a wrap. And what it does is it lets you take over the seller's existing loan subject to, and then resell that to a new buyer at a higher price and higher interest rate, right? Then you collect the buyer's payment, you pay the seller's loan, and then you keep the spread. Now, where do you find these buyers? Specifically from mortgage lenders who have clients who got priced out because of interest rates. And maybe they decided not to buy, or maybe they couldn't get the home they needed or wanted, right? For example, let's say we have a $400,000 house, okay? The seller's existing loan is 3.5%. You wrap it at $440 at 5%. And that buyer, because they had money for a down payment, they got the job, but because the interest rates are near 7%, they couldn't get approved for this loan at a 30-year fixed rate, but they can give you $25,000 down on this one, okay? Now, the monthly payment breakdown on this would be the seller's existing mortgage is 3.5%. That puts their payment around $1,796 per month. You wrap that loan, a new loan, up at 5% on $415, that's $2,228 per month. So you're making $432. You have zero liability on the property, and you don't have to make repairs. You don't have to do any of that stuff. You're just taking it on and then wrapping it around somebody else. Now, what the buyer gets out of that is, right now in today's market, 6.9% interest rate. The bank loan at $440 would be roughly $2,918 per month at 6.97%. And your wrap on that is $2,228. So that's saving a buyer $690 every single month. Plus, they didn't have to go through bank approval. They didn't have to qualify. They didn't have to get on their credit, all these things. That you're just creating a promissory note and you're attaching it in a second lien position on the property. And you helped the buyer save nearly $700 per month. And they got in the house that otherwise they couldn't afford, all while creating consistent cash flow monthly for yourself. Now the seller wins too, and it's going to protect them. It's going to create a win for everybody. And if you use a third-party loan servicing company, the buyer is going to pay the servicer is going to pay the mortgage, and the seller gets a peace of mind knowing the mortgage is always paid on time, and there's a clean paper trail. And the potential debt-to-income ratio, like I said before, is going to get wiped out after that 12 months. So if they want to go buy another home after their credit gets better, if they were in foreclosure, and it gets they avoid the foreclosure, the buyer gets a deal, you get paid, and that's what I call a triple win. Now you might be wondering, where am I going to find these, people to sell it to in a wrap, right? That's one thing that people don't usually talk about. And I'm going to give it to you right now is make friends. And I always tell all my students, make friends with all of the mortgage brokers in town that you can. The reason why I say that is because how many of those buyers we were just talking about that got pushed off on the sidelines can't buy right now. And they're like, I'm going to wait till rates are lower. Well, what if you can give them a lower rate? What if you can get them the house they wanted right now, or, type of house in the right location, with the right school district for their kids? What if you can do that right now, but give it to them on a wrap? And then now they don't got to go get apply for a loan. Then we got to put on their credit. They don't have to, hold that, whatever. And what happens is you still hold the deed, but you sell or finance it to them at that 5% we talked about earlier. This is a complete win. And this is such a beautiful strategy because it helps out the seller. You're making money and you're wrapping it to them, or you can assign it to somebody else and make money, like extra money now. And you might be saying, okay, but what if that person decides, they're not going to pay anymore, they're a bad human being, whatever it is? Well, guess what? You still hold the deed. They gave you $25,000 down on the wrap, and they probably don't want to lose $25,000. But if they did, you go back to the mortgage broker and find somebody else that is a good person that wants to do it, puts another $25,000 down. You just collected $50,000 on a property you never bought, never qualified for, never got a loan for, but you helped out the seller. And with that $25,000, keep it in reserves, keep a rainy day fund in case that does happen. So you can keep paying the seller's mortgage, or keep doing deals so you don't have to worry about your finances, right? Either way, this is a great solution for everybody. And if you want to learn more about this, or you want to download a whole little toolkit on creative finance, go to carlosbolton.com/creative, and let's get you ahead of the curve. Now, if this video resonated with you, if you liked it, if you got something from it, please like, comment, subscribe, and share it with people share it with other investors, share it with wholesalers, share it in your groups you're in, right? Be like, yo, this is a good video, I learned something from this is a strategy that's going to help everybody get unstuck in 2025. So if you liked it, like I said, please like, comment, subscribe, and share. Stay blessed by the best. I'll catch you in the next video.